X 100%. Engineer your financial freedom.
Hello and welcome. We're always told that investing is this big balancing act between risk and reward. But what if the number one rule we all follow, that if you're an aggressive investor, you should own more stocks, and if you're conservative, you should own more bonds? What if that's just wrong? Seriously, what if a Nobel Prize-winning economic theory says that everyone, from your super cautious grandma to a young, fearless day trader, should actually hold the exact same portfolio? It sounds crazy, right? Well, let's dive into this, because today we are digging into a huge contradiction right at the heart of modern finance. It's a genuine asset allocation puzzle. On the surface, this question seems pretty simple. We're all taught that basic formula, If you want more growth, you need more stocks. If you want more safety, you need more bonds. It's pretty much rule number one in every Investing 101 guide out there. But this one decision, your personal mix, has a bigger impact on your financial future than almost anything else. It basically decides how fast your wealth can grow and also how many sleepless nights you might spend worrying about it. And as we're about to find out, the clean, logical world of financial theory gives a profoundly different and honestly a startlingly counterintuitive answer to this critical question. Okay, so before we can really tackle the puzzle, we need to be absolutely crystal clear on the pieces we're working with. Because in the massive, complex universe of investing, pretty much everything boils down to two fundamental ideas. Are you becoming an owner? Or are you acting as a lender? Let's really break this down. When you buy a stock, you're buying equity. That's just a fancy word for ownership. You are literally purchasing a tiny slice of a company. Your financial fate is now tied directly to that business's success. If the company hits it big, invents something amazing, and grows like crazy, the value of your share can absolutely soar. Plus, you might get a piece of the profits in the form of dividends. The upside? Well, in theory, it's unlimited. But, and this is a big but, with ownership comes risk. If that company goes bankrupt, as an owner, you are the last person in line to get paid back. You could easily lose every penny you put in. Now, on the flip side, when you buy a bond, you're not an owner at all. You're a lender. It's like you're the bank. You're loaning money to a company or a government. In exchange, they promise to pay you a fixed amount of interest, these are called coupon payments, at regular intervals. And then, at the end of the loan, you get your original money back. Your upside is capped, but your investment is way safer. In that same bankruptcy scenario, bondholders have a legal claim and they get paid before any of the stockholders. So, to put it simply, stocks are high-risk, high-potential reward ownership. Bonds are lower-risk, predictable loans. Okay, so one is riskier but offers a bigger potential payoff. The other is safer, but with a lower, capped return. That's the theory anyway. But how has this trade-off actually played out in the real world over a really long time? Let's turn to the history books, or in this case, the historical data, and see what nearly a century of market performance can teach us. Now, before we look at any numbers, we have to get this straight. This quote from Nobel laureate Robert Shiller is absolutely critical. In our everyday lives, we tend to throw the words risk and volatility around like they mean the same thing. But in the world of investing, they are two totally different concepts, and understanding this difference is essential before we can make any sense of the historical returns of stocks and bonds. Let's get really precise here. Volatility, that's all about the journey. Think of it like turbulence on a flight. A volatile investment is one where the price just bounces all over the place. It's going to be a bumpy ride. Risk, on the other hand, is about the destination. It's the chance that your plane doesn't actually land safely. It's the real ultimate probability of a permanent loss of your capital. I mean, a stock like Amazon has been famously volatile its entire life, with massive swings up and down. But for a long-term investor, was it really risky? The destination has been absolutely spectacular. You can put up with a very volatile journey if you're confident you're going to get to the right destination in the end. And yep, the historical data absolutely backs this up. When you look at nearly 100 years of returns, you see this trade-off in action. Stocks have been way more volatile. The journey has been so much bumpier, with these gut-wrenching crashes and incredible rallies. But, as this chart shows, the average annual return has been up there around 10%. By contrast, government bonds offered a much smoother ride, but their destination was way more modest, with returns averaging around 5 to 6%. This chart tells a really powerful story. Over the long run, the market has handsomely rewarded investors for being willing to endure the volatility that comes with being an owner. So the history seems pretty clear, right? Taking on the volatility of stocks has led to higher rewards, and this simple observation is the foundation for all the standard advice we hear. But This is where our story takes a sharp and honestly a really unexpected turn. We're about to leave the world of market history and venture into the world of pure financial theory. Let's see what the academics in their ivory towers have to say about all this. So, what does the textbook actually say? Well, this isn't some fringe, wacky idea. It's built on something called the Capital Asset Pricing Model, or CAPM for short, and it's a cornerstone of modern finance. This framework was so revolutionary in its attempt to mathematically model risk and return that its creators were literally awarded the Nobel Prize. This is the orthodox, by-the-book, gold standard way of thinking about how portfolios should be built. Okay, you might want to sit down for this because this is the mind-bending part. The theory is called the mutual fund separation theorem, and it unfolds in 3 logical steps. First, the math suggests that for all the risky assets in the entire world, every stock, every bond, there is one single optimal portfolio that gives you the absolute best possible return for the amount of risk you take. Think of it as the one perfect recipe for a financial stew. Okay, now step 2 is the really radical part. The theory says that every single investor, no matter how much or how little risk they want to take, should use this exact same recipe. Your grandma and that college kid with the trading app, they should hold the exact same proportions of stocks and bonds. And step 3 explains how on earth this is possible. If you want to be more conservative, you don't change the recipe of the stew. No. Instead, you just take a smaller portion of the stew and you drink more water. And the water here is a risk-free asset like cash. So an aggressive investor might have their whole plate filled with 100% of that stew portfolio. A conservative investor might have a plate that's only 30% stew and the other 70% is cash. But, and this is the absolute key, the stew itself, that mix of stocks and bonds, is identical for both of them. So that's the theory. It's clean, it's elegant, it's backed by a Nobel Prize. It gives us a single, universal answer for everyone. Now, let's leave the pristine world of these academic models and step back into the messy reality of financial advisors, online calculators, and our 401k plans. This is where our puzzle truly takes shape. And here it is. This one image is the entire puzzle. You see that straight horizontal line? That's the Nobel Prize-winning theory we just talked about. Along the bottom, you have risk tolerance, from conservative on the left to aggressive on the right. The theory says as you get more aggressive, your mix of stocks to bonds shouldn't change one bit. So you get a flat line. But what about all those scattered squares? That's the real world. Each one of those is a recommended portfolio from a major financial advisory firm. And what do they show? A clear, obvious, upward-sloping trend. They consistently tell more aggressive investors to hold a higher and higher proportion of stocks. The two are in completely different universes. It's a total contradiction. And there you have it. That is the billion-dollar question. Why is there this massive, undeniable gap between one of the most celebrated theories in finance and the universal practice of the entire financial advice industry? Is the theory just some academic fantasy, completely disconnected from how the world really works? Or is every single financial advisor on the planet giving mathematically suboptimal advice? This isn't just a fun thought experiment. This has real implications for how millions of us are saving for our future. This is the Asset Allocation Puzzle. The authors of the Harvard paper that really highlighted this discrepancy were just as confused as we are, so they dug a lot deeper. And it turns out that the simple, elegant model makes a few key assumptions that just don't quite hold up in our complex world. The real world has some crucial components that the original theory just leaves out. So let's look at the clues they uncovered to try and solve this mystery. You see, a perfect theory requires a perfect world. But in reality, the model ignores the biggest assets that most of us actually have, things that aren't traded stocks and bonds. We're talking about your future earning potential over your entire career, what economists call your human capital. We're talking about the equity you have tied up in your home, which for many people is their largest single asset by far. The model also assumes we're all perfectly rational, calculating machines, when we know for a fact that human psychology and emotions play a huge role in our decisions. But these real-world factors, especially the non-traded assets, might just hold the key to the whole thing. This is such a brilliant insight. Let me show you how it works. Think about a 30-year-old surgeon just starting her career. She has decades of stable, high income ahead of her. That future stream of paychecks is an enormous asset. And because it's so stable and predictable, it behaves a lot like a massive, high-quality bond. So if you were to look at her total wealth, her financial portfolio, plus this giant human capital bond, it's actually super conservative. So to balance that out and achieve a truly diversified total portfolio, her financial portfolio should be almost entirely in stocks. The advice to be aggressive suddenly makes perfect sense. Now, let's contrast that with a 65-year-old retiree. His human capital is all spent. His total wealth is his financial portfolio. So to get the stability he needs, he has to hold more actual physical bonds. What looks like a contradiction is really just financial advisors intuitively accounting for the most important assets that don't actually show up on a brokerage account. So, we've gone on quite a journey here, from the basics of ownership versus lending, through a century of market data, into the really strange and counterintuitive world of financial theory, and then finally back out to a practical, real-world explanation. So what does this all mean for you as you think about your own financial life? So what's the real takeaway here? It's not that the textbook is right and all the advisors are wrong, or the other way around. The truth is, they both offer a really critical piece of the puzzle. The textbook model gives us this powerful, game-changing principle. You have to think about your total portfolio, including all the assets that don't show up on a statement. The advisor's recommendations are basically the practical application of this very principle. The goal here isn't to declare a winner, but to use these combined insights to think more holistically and more intelligently about our own unique circumstances. Ultimately, this whole thing brings us right back to you. We all have our own personal asset allocation puzzle to solve. So, what does your total balance sheet look like? Is your job incredibly stable with a predictable salary, almost like a government bond? Or are you maybe an entrepreneur whose income is tied to the ups and downs of the economy, which is a lot more like a stock? Do you own a home in a crazy real estate market? How close are you to actually needing this money? The right mix of stocks and bonds isn't some single number or a simple rule of thumb. It's a deeply personal answer that has to reflect your entire financial life. Thinking through your own puzzle, that's the essential first step toward building a portfolio that's truly right for you.